November 1923. Berlin is freezing. A single loaf of bread costs 200 billion marks. Workers are paid 3 times a day. Their wives wait outside the gates to rush the money to market before it loses half its value by dinner time. This wasn't a sudden catastrophe. It was a slow, creeping rot. A disease of money that began with a single, seemingly logical decision by men in quiet, respectable rooms. They chose to print. They printed to pay for a war. Then they printed to pay for the peace. Then they printed to pay for social promises they couldn't afford. And in 4 short years, they erased 99% of the wealth of the German middle class. Savings, bonds, pensions, all turned to dust. History doesn't repeat, but it echoes. And the same echo that flattened Germany in 1923 is now bouncing off the walls of the U.S. Treasury. The next 4 years, from 2026 to 2029, will not be a correction. It will be a reckoning, a great wealth transfer that will move trillions from those who hold paper to those who hold what is real. And the portfolio that survived the end of empires in 1914, the Great Depression in 1933, the death of the gold standard in 1971, and the global collapse of 2008 is the only thing that will survive this one. Stay with me to understand why. To see the future, you must understand the pattern. Germany in 1919 and America in 2025 share the same 3 toxic ingredients. First, a massive, unpayable national debt incurred after a global crisis. For Weimar Germany, it was the Treaty of Versailles. The war reparations were impossible. For the United States, it's the aftermath of 2008 and the COVID-19 pandemic. Trillions in bailouts and stimulus funded by debt, a promise made to the present, stolen from the future. Second, deep social and political division. In Weimar Germany, it was street battles between communists and nationalists. In modern America, it's a cold civil war fought on social media and in fractured communities. This division makes the hard, necessary choices, like cutting spending, politically impossible. And third, the most dangerous ingredient, the magic money tree delusion. When a government can't tax and can't cut, it has only one politically painless option left. It creates money from thin air. This is not a theory. It is the historical blueprint for every major hyperinflation in the last 200 years. Debt, division, denial. The pattern is locked in. So what is the trigger? The spark that ignites the gasoline? It won't be a housing crash or a stock market dip. Those are symptoms. The trigger will be a global trade war, escalating in 2026. It begins with a simple popular idea, protecting our jobs. The United States, under populist pressure, imposes broad new tariffs on major trading partners. Let's say a 40% tariff on all Chinese goods. The intention is to bring manufacturing home. The reality is a punch to the gut of the global economy. Immediately, prices for consumers on thousands of goods skyrocket. Your phone, your clothes, your car parts. This is the first wave of inflation, the visible one. Then comes the retaliation. It's inevitable. China, Europe, and other nations impose their own tariffs on American exports. Suddenly, American farmers can't sell their soybeans. American tech companies are locked out of foreign markets. Corporate profits plummet. The stock market, which was already wobbling on high interest rates, begins to break. This leads to layoffs, mass layoffs, and this is where the trap snaps shut. With a shrinking economy, federal tax revenues collapse. They fall off a cliff. But government spending does not go down. It explodes. Unemployment benefits, corporate bailouts for too big to fail industries, subsidies for farmers who can't sell their crops. The budget deficit, already projected by the CBO to be nearly $2 trillion a year, doubles to $4 trillion. And here's the moment of truth. The villain of our story is not a person. It's the unholy alliance of political cowardice and the power of the central bank. No politician will campaign on austerity during a depression. They will campaign on relief. And the Federal Reserve will be asked to fund that relief. They won't call it printing money. They'll call it quantitative easing, yield curve control, emergency liquidity operations. But it is printing. And this time it's not a slow drip. It's a fire hose. They will monetize the debt because there is no one else left to buy it. This is the mechanism. It's not complicated. It's a political choice disguised as an economic necessity. Let's move from history to the terrifying present. Look at the numbers on the dashboard. As of late 2024, the U.S. national debt has surpassed $34 trillion. It's a number so vast, it's meaningless. So let's make it real. The interest payment alone on this debt is projected to exceed $1 trillion annually by 2026. That is more than the entire defense budget. We are borrowing money just to pay the interest on the money we've already borrowed. This is the definition of a sovereign debt spiral. Now, let's look at what the government doesn't want you to see. The shadow statistics. The official inflation metric, the CPI, has been adjusted and reformulated dozens of times since the 1980s. They introduced concepts like hedonic adjustments, meaning if a new TV is better but costs the same, they count it as deflation. If you calculate inflation today using the same methodology the government used in 1980, the real annual rate is not 3 to 4%. It's closer to 10 to 12%. You know this intuitively. Your grocery bill, your gas, your insurance, that is your personal inflation rate, and it is in the double digits. Now for the international view. The Bank for International Settlements, the BIS, the Central Bank of Central Banks, has been issuing stark warnings. In their 2024 annual report, they warned of a looming reality check for global economies addicted to debt and easy money. They see the fragility. They know the system is stretched to its breaking point. Meanwhile, the Mortgage Bankers Association, MBA, reports that commercial real estate delinquencies are at their highest level since 2014. These empty office buildings are time bombs on the balance sheets of regional banks. These are not cracks in the foundation. The foundation is gone. The numbers are clear. The trajectory is set. All that is missing is the catalyst. The crisis will not announce itself. It will begin on a boring Tuesday in late 2026. The news will be a footnote. A U.S. Treasury auction for 10-year bonds is undersubscribed. It means the U.S. government tried to borrow money, and nobody wanted to lend it to them at the offered interest rate. Specifically, Japan and China, the two largest foreign holders of U.S. debt, will be conspicuously small buyers. Why? Because of the trade war. Why fund a country that is actively trying to kneecap your economy? This single event triggers a panic in the bond market, the most important market in the world. Interest rates, not just for the government, but for everyone, begin to spike uncontrollably. Your mortgage, your car loan, your credit card, all tied to this market. The president will get on television and say, everything is under control. The Federal Reserve Chairman will announce an emergency meeting, and then they will announce the only tool they have left. The Federal Reserve will become the buyer of last resort for all U.S. debt. They will create trillions of new dollars digitally and use them to buy the government's bonds. This is the hyperinflationary event. It's the moment the world realizes the dollar is no longer backed by the full faith and credit of the United States. It's backed by a computer keyboard and a political promise. And the rush for the exits will begin, not just by foreign countries, but by American citizens. A rush out of the dollar and into anything real. You cannot stop this from happening. You can only prepare for it. You can build an ark while the sun is still shining. The portfolio that survives this is not about picking the next hot stock. It's about surviving a currency crisis. It has 5 core components: a fortress with 5 thick walls. First, 25% in physical gold and silver held outside the banking system. This is not a speculation. This is wealth insurance. For 5,000 years, it has been the ultimate refuge from debased currencies. Second, 25% in productive, unleveraged real estate, specifically farmland. People will always need to eat. Land is finite, and it produces a yield. It cannot be printed into existence. Third, 25% in select international value stocks and ETFs. You must diversify out of the dollar zone. Own shares in companies and countries with responsible fiscal policies and strong balance sheets. Fourth, 15% in Bitcoin. Think of it not as a currency, but as the world's first truly finite sovereign digital asset. A lifeboat in a digital age. Its scarcity is enforced by mathematics, not by the promises of politicians. Finally, 10% in cash. Yes, cash. It is a melting ice cube, but you need liquidity for emergencies and for opportunities when the panic creates generational bargains. This is not financial advice. It is a lesson from financial history. The coming 4 years will be a storm that washes away the unprepared. Wealth will not be destroyed. It will simply be transferred from those holding promises to those holding real assets. The choice of where you stand during that transfer is yours.